The time value of money is a concept that states a dollar today is always worth more than a dollar tomorrow. There are basically three factors which contributes to the time value of money. First is the opportunity cost. Second is the inflation. And third is the risk factor. And all of this impacts the value of money over time. To give you an idea about the opportunity cost, imagine yourself winning $1 million lottery. Now, hypothetically speaking, let's say you don't have any expenses to pay for in next 1 year. So now you have the opportunity to put that money in bank for 1 year and earn a 5% interest and get $50,000 in the end. Or you could just keep the $1 million under your bed and sleep on it. But you will lose the opportunity to earn that extra $50,000 if you do this. That $50,000 is your opportunity cost. Inflation is the increase in price of goods and services over time. Let's say you purchased groceries from a store in 2019 and it cost you $100 to pay for all the groceries. But when you went to the same store to purchase the same amount of groceries in 2020, you had to pay $105. That 5% increase in the value of goods is the inflation. Risk is something that most investors try to avoid. The riskier the investment opportunity, the greater should be the reward to compensate to take on that risk. To give you an example, let's say you purchased $1 million rental property, thinking that it would generate a constant source of revenue for you over the next 10 years. But after you purchase the property, you realize that people in the area are not willing to pay your high-priced rent and don't want to stay at your property for several other reasons. Eventually, you realize it was a bad decision to pay $1 million for that investment. There are several factors that affect risk, like consumer preferences, competitors' activity, overall economic climate, changes in government regulations, etc. The combination of these factors affect the time value of money and usually is expressed as the percentage, which is a discount rate. The discount rate is unique to every investor, and as we just saw, it depends on what the opportunity cost you have. Do you have an investment opportunity which generates more income than the investment opportunity available to others? What is your perspective on inflation? Do you forecast it to grow at 1%, 3%, or higher? And in the end, what do you think about the risk of getting your planned returns on the investment? Now, before we switch to Excel, where I'll show you a real-life application of the concept, I would really appreciate if you could like and comment on this video with any questions you have or any suggestions you have. And also, if you could subscribe to my channel, I would really appreciate it. Let's switch to Excel now. So what you see on my screen is a real-life scenario where a construction manager had to make a decision between to either buy a new machine, which had a cost price of $18,000, salvage value of $6,000 after 6 years, and an annual maintenance cost of $3,500. Or a CM could have kept the existing equipment, which was purchased initially for $22,000 4 years ago. But its current price in the market is only $6,000 after using it for 4 years. The problem with the existing equipment is that it has a very high maintenance cost, and therefore we are considering time value calculation to decide which option is better, to buy a new machine or keep our current machine, given this information. We also have a minimum rate of return of 5% we want to achieve from this investment deal. This information was basically given by our superiors and which I'll show you how to use in our calculations. My first step is to create a cash flow of 6 years for these two scenarios. Starting with the old equipment, we have its current price of $6,000. Now remember, we have to look at the scenario from third party's perspective. Therefore, we don't care as to what the cost price was. We are only concerned with the current price of this old equipment in the market, which is $6,000. Now for next 6 years, we have annual maintenance cost of $7,000. And in the year 2026, we are considering to sell the machine for $2,000. And when you sum up all these values, you get the final cash flow from cell F8 to L8. We have created a similar cash flow for new equipment in a similar way. And in the end, we will get a final cash flow result in the cell F10 to L10. Now that we have cash flow for old and new equipments, our goal is to convert the value of this money we are receiving in future to its value in 2020, which is the present. By doing this, we would be able to know which equipment will actually cost us more in the present. To convert the value of future cash flow to present, we are going to use X NPV function. I'll type an equal sign in cell O4, X NPV, select our discount rate, all the cash flow values, and the dates corresponding to the cash flow values. enter, and we get a negative NPV of $45,000. We will follow similar steps to calculate the NPV for our new equipment. And now that we have NPV value for both the cases, we can see that purchasing a new equipment is costing us less than to keep the existing one. One other thing to note is that we have a negative NPV for both the old and new equipment, which means we won't be able to achieve that 5% minimum rate of return task given by our superiors. Because to achieve that, we would probably have to be able to sell the equipment for a much higher price than we bought it for, which is unlikely. Therefore, you can either prescribe your superiors to either find a better alternative than we have for our new equipment here, or if this is the only option available, we should definitely suggest them to go for purchasing the new machinery, as it will cost us less over the period of 6 years than to keep paying for the high maintenance cost of our existing machine.